My name is Ehsan and I'm a startup and commercial lawyer. I am a partner at a boutique firm in Sydney CBD, and I give advice to startups ranging from people who've just come up with an idea like you to people who've just raised millions and millions of dollars and are hoping to make it big on the stock exchange. Does anyone know the guy in the middle? Do we know who the twins on either side of them? They tried to sue Zuckerberg. Yeah. Well, what's interesting about this story, I mean, this guy is probably one of the most famous, one of the most influential people in today's world. But the idea actually started within these four walls. It was at Harvard University. The twins came up with an idea called Harvard Connect, and they engaged Zuckerberg to do the programming and to bring the platform together. Zuckerberg took the idea, changed it, and 4 months later created what's now Facebook. These guys didn't have an agreement that would reduce the writing. They had a verbal contract. But you know what's interesting about verbal contracts? People forget the key points. And because it's reliant upon evidence which is given orally, it's your word against someone else's. So if at this stage, in 2004, 2003, or whenever it was, there was a written agreement, there was an email chain, there was some correspondence, these guys would also be as well known as Mark Zuckerberg is to everyone today. This is a generally accepted model of how a business works and what the business life cycle is. And generally it's divided into 4 phases. The startup phase, which is where you guys are at, so you've got an idea, you haven't really made any money. The growth phase, where money starts to come in. There's a couple of bucks here, you've got a good idea, it's growing. There's the maturity phase, where some very fun and sexy things happen. And there's also the decline, and you probably don't want to be at that stage at any point of your business life cycle. And generally, this process takes around 3 to 5 years to expand itself out. But really, the seeds that you plant here will see you through everything else. What's also important is to make sure the discussions that you have with each other, with your co-founders, with your business partners, with your affiliates, are all documented and reduced in writing. Because if your business was to kick off, and who knows, it may or it may not, and when you're sitting at the peak of this, you don't want to walk away with pennies, you want to walk away with the millions. First thing I'll talk to you guys about is the legal structure, because this is different to what happens in Australia as well as many other Western countries. Each of the businesses that you've talked about will have to operate as a legal entity. In Australia, we have a sole trader, which is one person, coming together, say a plumber or a tradie or a lawyer or an accountant, selling their time and selling their wares as an individual. The advantage of that is that it's very easy to set up. All you have to do is just go and work and you get paid for it. It's relatively inexpensive, there's no registration fees, you don't need to pay anyone any fees. The disadvantage, however, is that any liability that you have is on you. So if you were to be negligent in providing a service, or you were to give the wrong advice, you're personally responsible. The second common way is the partnership, which is in essence a number of sole traders coming together for a common purpose, with a view of making profit. So generally the accounting bodies, your Deloittes and PwCs, these are partnerships. The big legal firms, they're also partnerships. But again, they don't give you the same level of protection that you need. And from a tax point of view, the sole trader and the partnership models, you would pay tax on your own individual tax rates. The more ideal company structures is the company and the trust. A company is a separate legal entity to the owners, the shareholders, and the directors. A company can enter into agreements and it can sue and be sued. So if a company borrows $10,000 and the company is not able to repay the $10,000, it doesn't mean that you guys are actually personally responsible to pay that back. And a trust and the company usually go together to protect assets of a company, for example, intellectual property, whether it's code or technology or any patents or anything like that. Can you be sued personally as a director? Yes, if you do something which is negligent in your duties as a director. if you engage in insider trading, for example, or if you don't act in the best interest of your company. But if you're offering a dating service and one of your clients is aggrieved, you know, they've paid you hundreds of dollars or thousands of dollars, and the connections that they've made or the services that you provided to them haven't been up to scratch and they want to sue you, they can't sue you personally. They sue your company. Hence why it's very important to make sure we protect your intellectual property and your business from day one. That's when 2 or 3 co-founders, or more in that case, come together to share ideas, to build a product or to build an idea with a view of testing it out. Once it reaches its minimum requirements, then they go to market. Because if it kicks off, how do you guys actually share the ownership of the company? If one partner, or if one co-founder was working 30 hours a week and the other one was only working 10 hours a week, how does that equate to an ownership of the company when the idea is tested and verified? Also, start to agree on milestones and things that are going to happen down the track. Are we intending on selling this business to someone else? Are we intending on getting bank funding in order to increase it? Are we intending on bringing additional partners on board? Have a look at your vision, consider what it is that you want to do, and put it all in this collaboration agreement that I'm going to send you. Because if the Zuckerberg and the Winklevoss twins had this agreement on foot in day one, Facebook would have been a completely different beast. How do you protect confidential information? Even more basic, what actually is confidential information? Well, confidential information is anything that's not made readily available to the public. So unless you type it into Google and it comes up, anything other than that is confidential information, particularly about a product or a business or an idea that you're developing. In this agreement, you also must say how the recipient of the information is to protect that information. So if you're giving it to a banker because you want to get $1 million loan, is it reasonable for them to share it with their other banking colleagues and put it up the chain of command? Yes, it is. Is it reasonable for an investor who's received an idea to put it on Facebook and share it with their friends? Probably not. And also, how long must the information remain confidential? If we're incorporating or setting up a company, it's very important to have an agreement between the members of the company, so people that actually own the equity in the company. If we go down the partnership path, we call that a partnership agreement. And that really says, what are the decision-making capacities of the owners? How often do the owners need to come together? What are the levels of, or number of board meetings that must take place, so on. Because again, what happens when you have 5 partners and 3 of the partners are doing everything and 2 of the partners are just resting on the laurels and relying on the profits or the success of the company? What happens in that instance? More importantly, when it gets to a point where the company is big enough or the business is big enough, how do you actually get rid of your shares? How do you sell the company? Does that need the approval of everyone, or does it need the approval of a majority? And this is where a lot of companies collapse under their own weight. They reach a certain amount of success because they rely on each other's word, the owners rely on each other because they've been good mates or founders or whatever the case is. And they don't necessarily plan ahead for certain events. What happens if the business goes insolvent? What happens if the business really succeeds and they want to bring on additional investors? All of this will be contained in the shareholders agreement. And it's got some important provisions about how do you fund the business? Do you go and get equity? Do you raise seed capital? Do you go to the bank? Do you borrow from mum and dad? Who operates the bank accounts? Is there going to be joint signatories? Or does one director or one shareholder have access to all the money and all the cash and all the intellectual property? How does the voting work? How do we vote on certain matters? If we want to take the business in one direction rather than the other, how does that all work out? So this all needs to come together in a shareholders agreement. But this is probably towards the growth stage. You don't necessarily need that as a startup. And very important for those who are doing business online, which is essentially everyone now, that opens up a whole range of risks. Again, In Australia, business is quite regulated. We are controlled about what we can say and what we can sell. If you make outlandish representations on your website about your product or your dating product or your health product being the best there is and being absolutely error-free, well, that's misrepresentation, because there may be errors. Your dating product may not bring people together as promised. And that opens up the risk of litigation. And the number of people that get caught in hyperbole and exaggerating their product, and marketing hype, which is great, but you have to do it within the confines of the law. And you have to have terms, conditions, service agreements to limit your liability when you're contracting or you're dealing with others. Also very important, if you are selling an app or you're selling some sort of an online service, how do you actually protect that intellectual property? What's stopping someone from reverse engineering your app? Your service agreements. Have you guys ever noticed that every time you download a product or you're downloading an app, there's a little tick box? But that terms and condition actually sets out your legal obligations to the consumer and the consumer's legal obligation to you. And one of the things, more often than not, almost in every online case, is the protection of the company's or the business's intellectual property. And it says that if you were to sell your app to me, and if I was to reverse engineer that, that actually gives you a right to sue me for breaching your intellectual property. But if you have a one-on-one relationship with your consumers, with your partners, you can protect your intellectual property through private contract. You ask, what's intellectual property? Everything and anything. It can be ideas, it can be systems, it can be technology, code, workflows, anything that you guys do to set up your business. And this is one of the major things that startups need to protect themselves from, because inevitably there are going to be people who are not necessarily more clever than you guys, who have got a lot deeper pockets, and they can get your idea and basically copy it and reproduce it on a much better, bigger basis. An indemnity is a promise to put you back in the position that you were if a loss or an event hadn't occurred. So if for whatever reason I lose $100 and someone promises to indemnify me, it doesn't matter how I lost that $100, they're going to repay that to me. And again, that's a private legal contract. What I want you to take away from tonight is to document your ideas with your co-founders. Try to figure out what exactly your idea is so you can keep it confidential when you're talking with other people. Make sure you have an agreement with your suppliers, the people who you're relying for information. And very, very essential, make sure you're minimizing your risks when you're setting up your website and dealing with your consumers. How do we protect our company? Well, there's probably 2 to 3 layers. The first layer is through legal documents and contracts. If you can exclude as much responsibility from doing things as possible, that's the best level of protection. The second protection, depending on which industry you're in, is to get insurance. A lot of insurance companies now offer indemnity policies. So you can indemnify yourself against legal loss for up to 2 to 3 million, provided that you paid their monthly fee. But if you get sued and because you've burned someone's house down, or someone's lost millions and millions of dollars, then you're in trouble. You want to have a trust structure, as I showed you, and you want to have a trust structure so your personal assets aren't on the line. Okay? But those are more sophisticated stuff. I mean, at the moment, I don't think you'd be at that point where millions of dollars would be at risk. But if a business is here, heading towards an exit or heading towards the maturity phase, there may possibly be a situation that a single claim may be worth millions and millions of dollars. Okay? So it would make quite a lot of sense to have indemnity insurance, to have private agreements drafted and so on at that point in time. There are a couple of pitfalls, and typically, it only takes 1 or 2 legal claims for any organization to go down. But prevention is better than cure, and it all starts now. I mean, you guys don't yet have a business, you're building a business. Take the time to document, put a few things in paper, sign it off, put it in the filing cabinet to never use again, but if it does need to be used again, at least you have some sort of protection. Okay?
Thanks.
Thank you very much.